This is Real Generational Wealth. Live from Southern California, this is Abby, Espy, and Jen.
Hello.
Hi, happy Wednesday.
Happy Wednesday. Welcome back, everyone, to Real Generational Wealth, where we have over 50 years of combined experience making sure you and your family always have a place to call home. Today is part 2 of our Getting Pre-Approved series, and we're going to dive deeper into CalHFA loans and reverse mortgages and a few other strategies into getting you a homeowner this year. So again, if you are watching this live, be sure to hashtag live. And if you're watching this on the replay, hashtag replay. Real quick, SB, I saw earlier this week you were published in a magazine. Tell us about that.
Yeah. Well, I still, as a baby boomer, I still believe in print ads because they like to have something to hold in their hand, The baby boomers still believe in
something tangible.
So this magazine here is a free magazine. We like free magazines. And this one is at the pavilion down the street where I live. It's called Living Well Today. So it really matches what my message is, where retiring style, I promote real estate for the baby boomers.
Right.
Yeah.
Nice.
I was lucky. I was able to get the first page right there. And if you see that burst, it says
it's like a promo.
Yeah, it's a promo. It says seniors in bold. See, seniors. And I said, I specialize in reverse mortgage as purchase and income for life. Free bonus for the first 20 callers. Yeah.
Wow.
I have an article too. So every month.
The first face that they see as soon as they open it. That's awesome.
Yeah. That's nice. They have it every month. I can contribute something else, a different article that reflects lifestyle for the baby boomers, leveraging on their real estate. Yeah. How about you, Abby?
Oh, me? Okay, so I guess since we're doing show and tell today, this is a book that I was published in. It's called Undocumented and Unafraid. It's about undocumented students that attend UCLA. They're exceptional students. It's just that, it wasn't their fault that they ended up being undocumented. And what I wrote about was that because there's that negative stigma with being undocumented, a lot of these students didn't have access to resources, unlike other undocumented students that were in the Latino population. So I interviewed Filipinos and other Asians, and it's just sometimes they would. It's just amazing, like the things that they would do just to go to school. Like we take driving for granted, and a lot of these students, they take the bus, and it takes them 5 hours and 3 buses just to get to school. So it's really nice reading about their stories, and I learned about a lot of them and all the struggles that they've gone through. So that is where I'm published, and then I was mentioned in. Sorry,
I could say my friend is published.
Oh, thank you. Hopefully, it's not the last time.
Exactly.
So, and then I have an article in Yahoo Finance. It's just about net realty, and then how me and my husband, how we were into sustainability, and we drive electronic vehicles, and we grow our food in the backyard, and we have solar panels, and recycle gray water, and also do a lot of composting. So that's our lifestyle, and that was on Yahoo Finance. So how about you, Jen? Did you get published, or have you been in any news articles lately?
Well, so I haven't been published, not yet at least. But last month,
Yeah, not yet.
exactly. Well, for those of you who don't know, I do have a clothing brand, my BPM. It's an EDM streetwear brand, and we got interviewed for our very first magazine. It was published this month,
Awesome.
actually. I think it was 2 weeks ago. And it was nice. I mean, I don't. It's digital. It's an online magazine, so I don't have a magazine like you guys.
What's the name of the magazine?
Voyage LA.
Okay. Okay,
Yeah.
so they can just Google Voyage LA.
Exactly. I'll post the link in the comments later. But it was nice to share kind of our beginnings and our story of how the brand came about and our message, which is basically peace, love, unity, and respect. And I truly believe that the world will be a much better place with more of that.
Yeah, that's an awesome message. That's
Yeah,
what you guys are
very
doing.
nice. Mhm.
But anyway, we're here to talk about real estate today. So last week we covered FHA, VA, and conventional loans and some of the qualifications needed. And to quickly recap, you need at least a 580 credit score for an FHA loan. But if you have at least a 620 credit score with a little bit of a better DTI, you can get a conventional loan for as little as 3% down. So I guess the way to think about it is if you and your co-borrower make about 90K with little to no debt and pretty decent credit, you can qualify for about a $500,000 house. And you could probably find something pretty nice here.
Mhm. Right.
So this week we wanted to bring Oliver back to dive a little deeper and answer some of your loan questions. So if you have any questions as we're going along, please feel free to comment and we'll go from there.
Okay.
What's up, Oliver?
Hi, Oliver.
Hi.
How
Hi,
are
Jen.
you?
Hi, Abby.
Welcome back.
Thank you.
Yeah, Oliver has been my favorite lender for the last 10 years.
Oh, thank you. Thank you,
Oliver.
SB.
We work together a lot and help a lot of first-time home buyers. Yeah.
Yes. Yeah. So I'm glad to be here. Thank you for inviting me again.
Of course. Well,
See,
speaking of
Oliver is
first-time
very detail-oriented.
No wonder you
Well,
like
he's here
him.
to answer all your questions. So again, if any of you guys who are watching, if you guys have any loan questions, please feel free to comment and we will answer them as we go.
Mhm.
But speaking of first-time home buyers, Oliver, you kind of touched up on it last week, the CalHFA loan, which is basically zero, down payment assistance, no down payment required. I know a lot of people have some questions about it. So tell us a little bit about that. I mean,
Sure,
who
yeah.
qualifies for these programs?
Right. So, so the CalHFA program has been around for many, many years. I think 60 or something plus years. So it's been around for a while, but they do run out of money sometimes. So you wanna apply whenever you can get it, right? So the way it works is this. I talked about the FHA and conventional loan as your first loan. Well, CalHFA has their version of their first loan. Okay, and then they have a second loan, which you're going to use for the down payment. Okay, then they have another piece of that, which is a third loan that you can use for closing costs. So there's actually 3 layers of this, and it's only for first-time home buyers, anybody that has not owned a primary residence for 3 years. So if you have a rental property in Washington, that doesn't count. You're still considered a first-time home buyer. Okay. And as long as you're buying in California, that you are going to live into this property, and it cannot be a second home. It has to be your primary residence.
Okay.
Is there something called a silent second in that CalHFA scenario?
Right. So I mentioned the second loan and the third loan that are attached on this tier, so to speak, right? So you have your 30-year fixed loan. It could be a conventional, it could be an FHA. The silent second is a lien on the property, but you don't have to make a monthly payment on it.
Okay, that's why it's called silent.
Until you sell or until you refinance.
Right. So that's the only time that they will call the loan due.
So
when you refinance yourself.
It's called silent because it doesn't show up on your credit report.
It does not show in your credit report. So because And because that's a good question, and because it doesn't show up in your credit report, there is no history of it. It doesn't help your credit at all. It doesn't hurt it either.
Okay.
Okay. Okay.
What about
Got it.
the rate?
Sorry.
What about the rate?
The rate on these type on a Cal HFA compared to your typical conventional or FHA loan is a little higher. Okay, so just and they and it costs a little more, so to speak, because they have a fee involved in it too. So you can call that as the catch, So we'll help you get the house, but it's going to be a little higher on the interest rate, and it's going to cost you a little more, but you get into the home.
When you say it's going to cost you a little more, are those upfront costs, or can you build that into this closing cost loan that you're talking about?
You know that the loan I mentioned, you have a second and a third loan to help you. So that third loan is going to help you pay for the closing costs.
Okay.
So you didn't really financed it, but they did help you pay for it by getting you that third loan. But don't forget, it is a loan, so there is a lien on it.
We have a question from Anne. She's asking if you can refinance it later. Good question.
You can refinance it later, but you have to pay it off on the refinance.
Okay.
Okay.
So if your loan, your first loan is, let's say, 300,000, and then the subordinate loan, we call them, is 20,000. You can't just refinance the first and forget the second, and you have to include the second loan on the payoff. So it increases your new principal balance.
Okay, got it. So what kind of buyer is a CalHFA loan for? Like, is it someone that is unable to save for a down payment?
Pretty much. I mean, somebody that has decent credit. I mean, for a let's say somebody that has a credit score of 660, I think 660, you can get you can get qualified for it. So you don't have to have excellent credit. Income-wise, you do have to qualify for their income restrictions, and it's different from county to county.
I see.
Okay, so there's income restrictions, credit scores. You don't have to have perfect credit. 660 will get you the assistance you need. They are pretty strict on the debt to income ratio. I think SB mentioned it, like a DTI.
Yes.
Yes.
So they are pretty strict on that, and they don't want you exceeding like 45%. Okay. But you can't pay down some of your debts though to qualify. So that's going to help you out.
Oliver, does it mean that if, let's say, my CalHFA Silent Second will have a monthly payment of $100 a month, would they include that $100 payment towards my debt that will affect my DTI?
Your Silent Second has zero payment.
Oh, okay. That's good.
So it doesn't affect your DTI.
Yeah, that's good. That's good. Yeah.
Right.
Okay, so thinking go ahead. Sorry.
Oh, so going back to Abby, what Abby was asking, what are the income-wise? I think I mentioned the score, the debt, the DTI, the type of home you can get. You can get condo, single-family townhouse. I believe they also have manufactured homes too. Not mobile homes. Though.
They have CalHFA for
I believe they have manufactured homes too.
Okay.
But it has to be your primary residence.
Oh, I see. And then does it have to be a new construction manufactured home?
Oh, that's a great question. Actually, the program that they have is called My Home.
Yeah, I've seen that. Yeah.
Yeah, so it's My Home. That's the Silent Second. And that is actually capped, maxed at 10,000 for the assistance.
Okay.
And if you are a teacher, not private, public, they have a list of the public schools, a firefighter, or you're buying a brand new home, that restriction is off. So you can qualify as high as 3% 3% for that program to help you with your down payment, not just
Okay.
10,000.
How about for frontliners? Do they have something?
Just the firefighters and teachers.
Okay.
That's all I have.
That would be good for baby boomers then. Huh, SB, like a lot of them are looking into manufactured homes too.
Yeah, they are. They are looking at some manufactured homes. See, manufactured home can be a mobile home, so it's going to be, it's not going to be a real estate. But if you own the land and put a manufactured home, that's a different category, right, Oliver?
Yeah. So a manufactured home is a home that is built at, like, let's say, at a shop, and then it is transported via truck and then pieced together. Let's say one half of the house, okay, is built on the shop, the other half is built on the shop, and then they just truck it to the land that you own, and then they just assemble it. That's different from a mobile home, which has wheels on it, right? And you don't own the lot. You are paying a lease to use the lot. Totally
That's
different.
a tiny
The
home
land lease.
on HGTV.
Yeah, that there you go. See, that's a manufactured home right there, tiny homes.
Yeah, yeah. So the Calhafa can qualify for a mobile home. You say
No, not mobile, not mobile.
manufactured home,
Manufactured.
where you own the land, right?
You own the land, just like Jen's example, the tiny homes.
Right, right. Yeah.
Okay, we have another question, Oliver. Connie is asking, how about for contractors and self-employed? Is there any special loan for them? Because I know a lot of 1099 contractors, they have a hard time getting a home loan.
Yeah, it is tough. 1099 are considered self-employed, so so we're gonna need 2 years of tax return because we're gonna be looking at their gross net income.
Oh, the net, not
Yeah,
okay.
not the gross net. And a lot of contractors, a lot of 1099, a lot of self-employed, they want to maximize their expenses so they don't have to pay in taxes. So
That's true.
it's kind of a
Yeah, that's true.
funny too, right? So no, there's nothing specific, nothing particularly just geared to those type of income or employment. At least for Cal HFA, it doesn't exclude them, but there's no special program for them. Not like teachers and firefighters. That's special.
Mm.
Okay.
Oliver, so for 1099 or self-employed, isn't it there are certain things that you can put back into the income on some of the expenses that they have?
Like some of the deductions.
Yeah, like for folks that have their own business, like depreciation. Okay, so that's not a tangible expense, so you can add that back in the income calculation instead of subtracting it from their income. So depreciation, things like that nothing tangible, right? If like supplies, you can't skip that one because that one you have to spend, right? But like,
What about the auto use? Automobile use, because we charge like 0.55 cents per mile. Is that something that you can put back if you deduct that? Because sometimes it can be a lot, like $15,000 on car expense, auto expense.
yeah, and it could also be the underwriter's discretion too, if they will accept it.
Okay. So
Okay.
Oliver, you spoke about VA loans last week. We have a question about VA loans, or do you want to move on to a different topic, Jen?
That's fine. I think we can answer that. I mean, so they're asking if you know of any specials for active duty military besides VA loans.
Oh, the VA loan is actually the best loans out there. So that's the only thing I can think of, really, is the VA. I mean, I don't think anything can beat the VA loan. I mean, if you can.
I had a question, like for VA loans, what if the one who is not a veteran, what if they're the ones that are the breadwinner?
Oh, that's okay. The spouse, let's say the spouse
Yeah.
is the breadwinner, and the vet is, let's say, not making as much. It's okay as long as it's a husband and wife. It's
Combined
okay.
income.
Yeah, that's
Okay.
fine.
Yeah, as long as he has the DD 214, then they can qualify for the VA, right?
Correct.
Yeah. Mhm. Yeah. So
Cool.
even
So
if
I have a few
your
questions about the
son,
Kalhafa when we want to
right?
go back to
Even if
that.
it's a son, it doesn't have to be spouse. It can be like your son or your dad that lives with you. Can it be
The VA has to be spouse,
a
not
couple?
yeah,
Oh,
not
I mean,
not
I
not
cannot
your
use my son.
your son can get it, but he can't be on the loan.
Yeah. But a lot of people they want to have like 5, 6 people on the loan so they can get a bigger home. So you wouldn't be able to do that on a VA loan.
No,
That's a
no,
restriction.
yeah.
Mm.
So are those kind of restrictions the same on the Kalhafa loan? Like, is there a maximum number of co-borrowers you can have?
Well, on the Cal HFA loans, there is no not there is a restriction, but not like that. Not like that. Okay, you cannot have a non co-buyer that is going to
Okay.
live a non-occupant co-buyer, I should say, non-occupant
Okay.
co-buyer. So let's say you have an uncle, okay, oh, I'm going to help you buy a house, okay, but I'm not going to live in it because I live somewhere else. You can't do that. Okay, you can't add a non-occupying co-buyer buyer. But typically, let's say on FHA, yeah, you can do that, but not on a Cal HFA.
I don't know Kalhafa.
Not on a Kalhafa. So okay, so let's leave alone the Kalhafa right now, and let's look
Okay.
at some other ways to find to buy a house with some other creative way, right?
Yes. Like
What
I
about if like I'm going to buy and my brother is gonna buy and my son is gonna buy and we're gonna buy a fourplex and three of us are gonna occupy three three of them, 3 units, or maybe 2 units, and then the other two are going to be like we're gonna rent it. Can we use the income of the 2 units to
Ye-
increase our income to qualify? How does that work?
Yeah, absolutely. So with conventional and FHA financing, a 4 unit is the maximum that you can finance. You can finance using these loan programs. Anything beyond that is going to be considered
Right.
commercial.
right.
Okay,
Yeah.
so you can have a 4 unit home. Two you're gonna live in, or one. Let's just say one. Okay, you're gonna live in one. Okay, and then you're gonna rent out the other three. Perfectly fine. Perfectly fine. Now we do have to accommodate for vacancy, right? So we're not, if you're going to rent out 2,000 a piece, we're not going to take the whole 2,000. We're going to take 25% less
So
of the
75%.
right of the income that you're going to generate on these each units. But that's a great strategy actually, because you could basically have your renters pay the mortgage.
Pay your mortgage. Yeah.
Which kind of reminds me, for the Cal HFA, you cannot have a multiple unit on a Cal HFA. You can only have just one.
Oh, okay.
Family home. Oh, okay. Yeah. Yeah. So what about those like here in where I'm living, there's a lot here where there's a single family home and in the back there's going to be 3 units in one lot. So that would still be considered fourplex, right?
Do they have their own address?
No. It's gonna be like 1, 2, 3 units in the back, and then you know how they have like there's one that is a bigger house, and then at the back there's going
Okay.
units.
So
EDU.
a additional dwelling unit, ADU. Is that what you're talking about? So
Yeah,
like an in-law quarters.
say, but there's still houses there that would have like 3 units in the back, and
Yeah.
then
Yeah, that's going to be considered just one unit as
Mhm.
far as I know. Okay, so the additional dwelling unit is going to be part of that because it doesn't have their own address, their own PG&E meter, so to speak, right? So
Mhm.
they're just considered
So I
one.
had a situation like that. It was one of our listings. One of my investors flipped the property. It was a house, and he converted the back garage into an ADU, an accessory dwelling unit. The borrowers or the buyers that we accepted in escrow were FHA. Yeah, I think it was FHA. But because it does have its own, it does have an address and it does have its own meters, we thought that they would be considered as two different units, or like, or, I'm sorry, like a duplex. But the lender ultimately said because it's an ADU, you can't use. I guess it was the way it was approved by the city, the way the permits were approved. As an ADU, you can't use the rental income. It has to be on title. It has to be strictly either a duplex, triplex, or quadruplex.
Yeah, it could get a little tricky. You know, the way the property is zoned, as you mentioned, Jen. Right. So maybe that's something that your viewers could probably, you can show your viewers what actually happens when you get a prelim. You know, just kind of take a peek at what a prelim is and what title does. So yeah, this is part of the process. Sometimes it's a go, sometimes it's a no.
Mm-hmm.
Because I've had transactions where it looks like a townhouse, but it's zoned as a condo, and it foils a lot of things up because now I was using an FHA, which is perfectly fine with a townhouse, but then we find out when we got the preliminary title report, it's a condo, and the condo project turns out it's not FHA approved.
FHA. Yeah.
Then it becomes a problem. So it's always good to work with with you guys, with the realtor, right off the bat, when you guys are searching or your buyers are searching. So it's not enough to just go into Zillow and say, "Oh, I found a house." You got to talk to your realtor to do the digging.
Especially with the newer homes right now, because there's a lot of homes that can be in the new development, where they look like single family homes, but they are PUD.
Yeah.
And they have an HOA.
Yeah.
So what happens to that one, Oliver? Is that the same thing that you have to be an FHA approved for that development?
No, that one's okay. If it's a PUD or PUD, it's okay. We consider it the same as a single family home. It's when you have a condo that what you thought was a townhouse, and turns out to be a condo. It's when it comes a problem. It's the condo.
Mm-hmm.
I think with a condo, it's limited, like your rights.
Yeah.
That's why it's hard to get into by FHA.
Correct.
It's like something like you own the air. Like you own the air, but not the structure. You own the right to be in there and breathe the air.
Basically.
Yeah, so it does matter when your home buyers are looking at, hey, you know what? I can't afford a single family home. Now I'm looking at these type of homes. Maybe I can just get into a condo or a townhouse, and they're debating, well, which one should I go for? See if they can go with a townhouse, because the financing changes when they move towards a condo.
Yeah.
It could be bad, right? Like a condo project that's not approved, or it could be no big deal because it's approved. Now that could be detrimental if your home buyer is really just stuck on an FHA, meaning they don't have the credit score to go to conventional. They have a high debt.
DTI. It's mostly the DTI why they use FHA.
Right. So it becomes detrimental because you can't switch it to a conventional at that point because they couldn't get a loan through conventional financing. So they are not going to get that house. But they say, no problem. Okay, if it's a case of FHA, they can go FHA or conventional. They can just flip flop, right? If they find a property, a condo that's not FHA approved.
Oh, we have a question. I think I asked you this earlier. It was about using your 401k as down payment. So Connie is asking, how does that work?
Yeah, so you can contact your 401k administrator on how much they would allow you to withdraw, but you can use your 401k. And as far as penalty, like early withdrawal penalty, if you're using it to buy your first home, as far as I know, they're not going to penalize you as
Yeah,
long
they
as,
waive that.
but you do have to show like a proof that you are buying your first home, like an RPA, your contract. RPA means stands for ladies. RPA.
Residential purchase agreement.
There you go. Okay, so you need to show that, okay, to prove that you are buying your home, and you'll be fine.
Yeah. Yeah, it's funny because like we just finished one escrow and with Oliver, and this couple were just 26 years old, and they both work in the same company. So at first they were thinking that they only have $8,000 in their savings, but then when we pried on it and asked and questions and said, "Well, by the way, do you have a 401k?" And they said, "Yeah, we have a 401k. So how much is it? 30,000 each." Because they've been there for 5 years. So the bottom line, they ended up having $12,000 each that they would be able to use. So a lot of times, that's the reason why we always say that it's good to be transparent, especially with the buyer, giving us information and us asking all the different possible questions, is because sometimes the buyers don't realize what they have or what they can afford,
Right.
and so voila, for the $8,000, and now they have 12,000 each, so they have $24,000 plus $8,000 that they can use, right? Yeah,
Right. So
yeah.
as far as the down payment, yeah, you can use your 401k. You can use a gift, gift money. If you have an uncle or an aunt who wants to help you out,
Or
they
mom
can
and
use,
dad, you've got a lot
yeah,
of equity, right? The baby
right.
boomers have equity.
Yeah, so it,
They
it
own a
could
home.
be your mom that has a house that wants to you pull equity out of the house that they live in to help you get to your house. That's okay. They allow that. Um, we just need to make sure that it is gift money. It's not borrowed money. So that's the only thing,
Even a gift letter, yeah.
right? And normally I provide
Oh
the gift letter.
no. Oh, what happened to Jen?
We lost Jen.
She's the host.
So now you're the host, Abby.
I'm
Okay,
the host? Okay.
yeah.
All
Ask
right. So so let's talk about FHA.
Yeah, so FHA, as I mentioned, it's one of the program that allows you to get in with the smallest amount of down payment, which is the biggest obstacle that a first-time home buyer will have.
Well, what I'm
Um,
finding with FHA is it's hard to find a property that qualifies for FHA, like a townhome or condo that qualifies for FHA. So,
Condos, yes,
but
condos.
townhomes. So most townhomes are FHA certified, like the townhome community.
Um, the townhouses are considered just like single-family home as far as the FHA financing goes. So they don't have to be FHA approved as far as the project community is concerned. So what comes down to that zoning. I think Jen was touching on that. The zoning is important. Is it a town?
Welcome back.
I'm sorry.
That's okay.
Yeah.
Yeah. So as far as the FHA goes, the type of property, yeah, it's the restriction comes in when it comes to condominiums, but townhouse, you're okay.
I just
Yeah.
find that a lot of the communities they have an expired FHA certification.
Oh yeah,
So,
yeah. Those
like
are
it
the condos.
expired in 2012, 2011,
Right.
and then
And
they
And
they
they
never
don't
bothered
really
to
find
renew.
it. Yeah.
and yeah,
Some are not
and
motivated to update that.
yeah, and the thing with that is some might say, okay, well, they can just do a single unit approval for that. So instead of the whole project, just do that single unit FHA approved. Tried that. It's a little tough though, okay, because the HOA still has a say, still has to put some money, and it has to go through the HOA board to approve it. So Sometimes it works. Sometimes it's just boy, it's tough to get some of these approved single unit.
Yeah, especially right now, when there's multiple offers and and we don't have enough inventory out there,
Yeah,
So it's better that you have different options for your buyer,
right,
especially when they are looking for condo.
right.
So the sooner or the earlier that you can educate them on that the possibilities of you not getting qualified because the condo that she likes or that buyer likes is not an FHA approved, then the better for you, because then they would not feel frustrated. They would know that they are, that they
And
should not be looking at the properties, or they can look at other options where they can roll into what other options, Oliver? In the conventional, right? They can still go conventional with a 3%.
yeah, conventional.
Yeah, yeah.
Sometimes if they need more income to fix the DTI problem, they could pay off some of the debts to
Mhm.
qualify a conventional, or they could add in another source of income, such as maybe a co-buyer. Brother wants to help out the other brother, so he adds in another 50,000 worth of income, so they can now move to a conventional loan type of loan, coming from an FHA, so they can get the house. So those are kind of things that they can do.
Mhm, mhm.
Yeah, so you can always find a way if you really want
Right,
to make it
right,
happen.
right. I mean, if the biggest thing really, that I have a problem with in helping somebody, it's not the down payment. It's really the credit. The credit,
Mhm.
the credit is big. So you guys should do a show on credit, actually.
Yeah,
uh, the
yeah.
credit is a big deal, and a lot of home buyers think it's the down payment that they need help on. But if they take care of their credit, there's programs out there that's going to help them with the down payment,
Mhm.
right?
Do you recommend like one of those credit repair agencies?
Oh
No,
boy,
I don't.
no.
I don't. I don't. A lot of them are scams.
I mean, I think some of them are reputable. I mean,
Some of them are. You
yeah,
just need to know.
I work with some companies, maybe just a handful. I wouldn't say a handful, maybe like one or two actually, that help with credit repair.
Mhm.
But some, you just have to be careful. You
Yeah.
just
Yeah.
have to be careful. I mean,
Especially when they
You
ask
end
for
up
money up
having a
front.
bad credit anyway.
yeah, because I've had a client, an applicant, that has bad credit, and then I ask her, okay, hey, so are you trying to fix your credit? Says, yeah, I'm working with this company. I'm not going to say the company's name. And so, what are they doing? Well, they're going to renegotiate the debt that I owe and pay it at 70%
Mhm.
of the balance. So they get, let's 30% off basically of the money that is owed. Okay, so that's cool. So what's happening now? Well, they just tell me to make payments. Wait, so if you're making a payment, who are they paying? Are they paying it now? Are they paying the bill, the credit card? Says, and they told me no. They said no. So what's going on? So they're not making payment, but they're accumulating the money, and
Mhm.
then at one shot they're going to make a proposal to the creditor. Hey, we're gonna pay your this our client's debt, but you have to reduce the the balance, I should say, the balance on the credit card by 30%. Then we'll pay it off one shot.
Mhm.
Not a good strategy, because while that's happening, no money is being paid to the creditor. Late fees are piling up. They're reporting the mispayment to the credit bureaus. So now you're gonna see your credit scores just drop if you use one of those programs. So you have to be really careful.
Isn't it temporary? Like, is it just temporary, the lower credit score, or
I
I
wouldn't say temporary. It's
because
gonna
that's
be
what
there.
a lot of people are told. Like, your score will be lower temporarily, but then at least you
And then
don't have to
hopefully
worry
it'll
about
go
all
back.
this debt.
Yeah.
I don't know.
Practically, Abby, the way it works is that the credit company is going to challenge all your
No,
credits.
I understand how
Yeah.
it works, but
Yeah.
it's just some people
Right.
that's the perception they get is that,
Right.
oh, they're gonna help me, but they don't realize like it's gonna show up on their credit
Yeah.
and it'll say paid for less than the full amount and it's gonna get charged off, and they just don't realize the negative impact on their credit.
Right.
So
Right. And when you say temporary, it's kind of relative,
2
right?
years.
3 years. Okay. So you
Yeah.
can buy a house for
2
3
years,
years.
2 to 3 years.
That's a
so if
long
your
time.
aim
That's a
is
long
only to buy
temporary.
a house,
Temporary.
if your aim is just to buy the house, then probably you got the goal. So if you buy the house now and then all the other bad credits go back after you bought the house, then probably you say, oh, okay, well, it helped me anyway because I was able to buy the house.
Mhm.
Right.
Yeah.
But you have to be really careful about those credit repairs. You need to know exactly what you're doing.
Right. Since you're talking about credit and debt, one of the worst thing that you can do in preparation to buying your first home is accumulate debt, obviously, right? But the
Yeah.
biggest debt that you can accumulate, well,
Don't go shopping.
don't go shopping for a car.
Don't get a car.
Don't go shopping for a
Furniture. You're buying
Okay.
your bedroom set already without the house yet.
because that car that has a monthly payment of $600 is going to reduce your qualifying purchase number in a big way. Let's say you without it you can qualify for 600 and you just dropped it to 100.
Right.
100 less, I should say, to 500.
Mm-hmm.
So from 600, got a car, now you're down to 500,000 purchase price. Just an example. So watch out on that.
Don't looking for a house.
payment.
Don't buy a car yet.
Yeah, buy
Yeah.
your house number and don't co-sign. Don't co-sign for anybody. Don't
Plus,
co-sign.
a car is a depreciating asset, so it's better to just put your money towards your home rather than having big car payments.
Right. Now you can always buy it after. Yeah.
Yeah.
And co-signing. Co-signing is also not good. Okay. If I've
A lot of
had
people do
clients that they're co-signing for student loans for their son, their daughter. Okay, and then they're trying to buy a house. Well, that becomes a problem too because now they're equally responsible for that debt.
Oh, okay.
So it's a double whammy.
Yeah.
Son is you can't put the son there for their income, right?
Yeah.
Because they have that debt,
That
and you co-sign. So
Plus,
doesn't hit you
just don't
twice, it hits you
co-sign,
once.
period. Don't co-sign for anyone. Because there's a reason why you're
Especially with
co-signing.
the Filipino family, it's very common that we co-sign.
right.
Yeah, that's why I mentioned it actually because I have a lot of Filipino clients, and the things that that would come up is mom, dad trying to help their son or daughter to
Buy a car.
buy a car, so they co-sign to get that car, right? But my son's paying for it. Okay, great, but how am I going to show that your son is paying for it? Is it coming out of your son's account? Says no. My son just gives me cash.
Yeah.
You know what we do is we sign up our kids for credit cards so that they can start building credit early, even though they're young. You can do something like that just so they have their own credit profile already built, and then they can just buy a car on their own instead of relying on mommy and daddy all the time.
Right.
That's a good idea, Abby.
And yeah, and it a lot of really people need to understand the importance of credit and leveraging credit to get wealthy. That's what your show is about, right? Getting wealthy, right?
Yeah.
Building wealth.
Building wealth, right? Building wealth. So it really starts with credit. With credit,
They
really.
don't teach you that in school, right? No one actually tells you that credit is that important.
That's
Yes,
right.
that's right.
Yeah.
Yeah, in school they teach you social studies, but it's like, how do you apply that to real life? So
Yeah. So the I mean, especially now, right now, interest rates are so low. Money's so cheap.
Right.
Money's
oh
so cheap,
yeah,
Yeah.
and affordability is just a lot better than when it was what 5 years ago or so, right? Because
Yeah, actually,
you,
this is really the best time to buy because the credit, the interest rate is really low, you know, and there's a lot of opportunities out there. This is good time to buy.
there
yeah, I
are,
mean,
but a lot
Yeah.
of people are hesitant right now because they're like, we don't know what's going to happen with COVID, and they don't realize that after COVID, the interest rates are going to go up. Like maybe we don't know how much, but at that time they might not even be able to afford the payment anymore.
right.
Mhm, mhm.
I mean, what do you guys see as home prices are right now? Are they staying the way
They're
they
at
are? Are they going up?
they keep
They
going
have
up.
They
increasing.
keep
Going up.
going up.
Yeah, they
Everyone
keep
always
going up.
says, I'm gonna wait, I'm gonna wait, I'm gonna wait till the
Yeah.
market drops, and it doesn't drop.
And you
Yeah.
might not ever buy a house if you keep waiting.
Yeah.
If you would
Yeah.
have bought a house 2 years ago and not waited, like you would have all this equity by this time. So
Mhm.
that's just
Right.
something for you people or for whoever's
For
watching for the
everyone
viewers.
to think about.
Well,
Yeah.
what about what about the baby boomers on the reverse
Right.
mortgage as a
That was
purchase?
the
Maybe
one
tell me
last
a bit
loan
more about
option we wanted to talk about, like reverse mortgages. I don't think a lot of people actually they never really understand reverse mortgages and how do they work.
that. Yeah.
So Oliver, how do they work?
Okay, so reverse mortgage. Okay, so you have your forward mortgage, which is your conventional FHA loan, okay, that you see when you go to the bank, okay, and you go, oh, yeah, I want to apply for a 30-year fix. That's a forward mortgage. Okay, everybody knows that one, right?
Yeah.
You make your payment, it goes towards your principal, it reduces your principal. A reverse works this way. Okay, instead of you making payment, you don't make any payment on the house. Your house pays for your mortgage. So it's instead of
Oh, yeah.
principal going down, your
Mhm.
principal is going up, right?
So it's reverse.
It's
Mhm.
in reverse, right?
Mhm. Mhm.
The thing with that is you have to understand what compound interest is.
Hmm.
Compound interest. So you have your
Doesn't sound good.
principal. It doesn't sound good, huh? It sounds good if you're
No,
like
it
say
sounds terrible.
it sounds good if you're the one making money, right?
Yeah, if you're the
If
lender.
investment is compounding interest. Well, basically what it is compound interest. You have your principal. You didn't make your monthly payment, so the payment goes on top of the principal. It's principal plus
Compounded.
interest. Okay,
Mhm.
then the next payment's going to be based on principal plus interest, and then the interest is stacked on. So it's stacking up, right? It's compounding,
Okay.
right? So your principal is growing, and usually these are programs to help the older generation because they have so much equity in their home. It's like SB said, it's for the baby boomers. The baby
It's a lot of
boomers,
them that are. It's not for every baby boomer. It's not for everyone. But a lot of baby boomers are cash poor but equity rich. So
yeah,
it's ideal for those who have lived in their home for the 20, 30 years and they have not really tapped on their equity.
Mm-hmm.
So if they have like 80% equity or they have paid it in full, you see all these little houses that are really falling apart and they're just still there and they've
yeah,
lived there
Mhm.
for a long time. So if they have not really used their home as an ATM, in other words, refinance and cash out to the max all the time, you know,
Yeah, a
then
lot
they
of
can
people
turn
say.
around
right.
and
So
yeah, use
these
that reverse mortgage.
right. So the reverse mortgage, it's not for everybody. Just because you're old doesn't mean you're automatically gonna get it. Okay, one thing. Okay, you have to be 62 years old. Okay, at least one of the owners. Your spouse could be younger than that, but um, one of them has to be 62 years old. Then
Mhm.
we have to do a financial assessment. Okay, we also look at credit. We also look at credit when so it's not automatic. We understand that income is not all there. Your social security, your pension, that's all you're getting. Okay, so It plays a factor, but not a big factor. Okay, that's a financial assessment part.
So they
Okay.
still look at your FICO score, Oliver?
Yeah, we do.
Mhm.
Yeah. So we take a look at the score, and the credit profile. Okay, but we're not going to say, oh, you know what, you have a credit score of 600. We're not gonna do it. You know, we have to take a look at the whole profile, the whole file. And with these reverse mortgages, they're usually looked at by an underwriter manually. See, the forward mortgage, we run those through an automated system, a computer system that says yes, approve or not approve, right? But with these reverse mortgage, they actually have to be looked at by an underwriter manually. I mean, with eyeballs, real eyeballs on it. Okay.
Aurora has a question. She's asking if reverse mortgage is good or bad for almost retiree couple.
It's a case by case because
So every situation is unique.
every situation is unique. Okay.
Mhm.
If you are planning to leave this world with a home that is paid off, that's not the right tool. Okay.
Mhm.
Yeah, because that's not going to work. Okay. If you want to leave your house to your kids, um, paid off, okay, that's not that. This is not it. Okay. If you're gonna use the money for I don't know, buy a commercial complex, okay, that's not real reason why these programs exist. It's to help retirees during their retirement years. Because what happens is when you're on a reverse mortgage, you do not make a payment for the rest of your life. For the rest of your life.
So is this for baby boomers that have financial hardship? I mean, would
It-
you say
It-
those are the
it-
ones that have reverse
We have some
mortgages?
problems with cash
Yeah,
flow.
you know what? Unfortunately, people that approach me, okay, are going through a financial hardship. They need more money. But I want people to actually consider this when they're talking with their financial advisor about financial retiring during their retirement years. They could incorporate this, so they don't have to tap into their pension.
Mhm.
Okay, if they could maybe take some money out, okay, from the equity with a reverse mortgage on, let's say in 1 month, okay, or in a quarter. That's at one, because you can do a monthly income. Okay, you can receive income from it. You can sign up for that. You can receive it quarterly, or you can just use it as a credit line whenever you need it.
But what happens if one of the borrowers or one of the owners passes away?
Oh yeah, yeah. So when you have a spouse, well, if they started off, as husband and wife from the beginning, then it just goes to the whoever's living, husband or wife, right? So then it stays where it's at. You don't have to refinance or anything,
But there
right?
is the caveat that they still have to pay their property taxes.
Yes,
The
The
yes.
surviving spouse does not have to leave the house.
No. The surviving spouse doesn't have to leave the house as long as they were on title from the beginning.
What if they weren't on title?
That's a different story.
It gets complicated, right?
Complicated.
You can refinance again and get a
But they
reverse.
would have to qualify for the refinance. And if they had a reverse mortgage in the first place, it's like I would assume that it would be difficult to refinance.
So it gets a little tricky if they were not on title.
Mhm.
Okay. But I want to kind of emphasize what Jen mentioned. So when you have a reverse mortgage, your responsibility is the upkeep of the house, and you have to pay the taxes and the insurance.
Okay.
Okay, so that's important because if you don't take care of the house, they can recall the loan, basically.
Yeah, you can
You'll
take
be
a
involved, and the
foreclosure.
bank will take it back.
Yeah, they will take it back. They will take a loan back. Okay, if you don't live it, because they're going to assume that you don't live in the property anymore. That's one of
Oh,
the
okay.
conditions that they have on these reverse mortgage. You have to be living in that property as your primary residence. Okay, so I mean, you could be on vacation. Let's say you live 6 months here and 6 months, let's say in the Philippines. Okay, that's okay. That's okay. Okay, but
Oliver, we just got a question where do the owners have to be married on the reverse mortgage, or can both of them just be on the loan?
um,
They can just be co-owners.
that's a little tricky.
If they're
I
both 62 and over and they're living together, they don't want to get married anymore. They can do a reverse mortgage. They
Forever
cannot do
bachelor
a
and
reverse
bachelorette.
mortgage, Oliver.
Also, contact an
Saying that
attorney for a prenup,
they have to be married.
or contact an attorney or something for title.
I
now
don't
how
agree with
now,
that.
but see, then you have to think about, okay, how are they currently holding title right now?
Joint
Right? How
tenant.
how are they holding title right now? Husband and so obviously it's not
They
husband and
can
wife.
still be
I mean,
joint tenants without being married.
Single man and
because
single woman.
Joint tenants.
But tenants in
Okay.
common, does it have to be joint tenants?
so they're both owners. So they're both
Yes.
owners. So
Yeah,
it
they're
should be
both
fine.
owners. Yeah.
Yeah. But if they're living together and one is on title, one is not, and we've seen those, then we may have an issue there,
But would
right?
that
'Cause
be considered like common, how do you call that? You are,
what
they
is
have
that,
a
common
saying
law?
with that. Yeah, common law. Common
Okay.
law.
Yeah. The reason why it just this pops into my head is because I have a situation, and it's a situation where the the husband is the owner of this house, but the wife quit claim ownership on that house because the house that the husband bought was well, he received help from brother and sister, and the wife didn't get along with the in-laws, so she wants nothing to do with the house. Now, this is not a reverse mortgage scenario. This is just a scenario that came into my head when you mentioned about SB mentioned that. So it's a case by case, basically.
Okay.
So the bottom line is, we have this podcast, and of course, there are a lot of people listening to us, and we're just introducing different options on how you can get approved or how you can get into a house. So you can use reverse mortgage as a purchase, you can use FHA, Calhafa, but the bottom line is that there's always a case-to-case scenario.
Yeah.
So no borrower is identical to the other. And the best thing is for you to be able to be freely ask your realtor and a matching lender that can help you or coach you on the best way to do it. And the good
Yeah.
thing about being here in the United States, a good thing about it here is that realtors don't get paid per hour. We get paid by transaction. So we can get zillions of questions, 20 people, 30 people calling us and asking us questions. We don't get paid, not until we close a deal. Right, Jen?
Right. And you as the buyer do not pay us. So all you
Right.
buyers, yeah, you don't pay us. You
Yeah,
don't
it's
pay
the
the
seller
agent.
that
Yeah.
pays. Yes.
Also, if you feel intimidated or scared to ask us questions, I mean, we're here, just use us as a resource. You can contact any of us and we'd be happy to answer any of your questions related to real estate.
Mhm. Yeah.
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 And
The good thing about realtors and loan officers, unlike lawyers, you can call and ask them all kinds of questions. And if you get a real good, dedicated agents and loan officers, they're going to hold you by the hand and coach you, and we're not going to send you a check for a consultation fee. Right?
Exactly.
Yeah.
All right. Well, my video is glitching in and out, so I think that's my cue.
Okay,
But thank you, Oliver, for being on today's show again and answering all of our questions. Again, if any of you guys do have any questions about buying or selling, you can direct message us at any time, and we'd love to help you. Next week, tune in. I think we're going to be talking about, I guess, the rest of the buying process. As soon as you get pre-approved, what's next? Other than that, thank you guys all for tuning in, and we'll see you next week on Real Generational Wealth.
That's right. Yeah.
Bye.
Thank you.